Hello, and welcome to Wolf & Company's on-demand webinar. My name is Stephanie Creedon, and I'm a member of Wolf's marketing department. Today, we'll be discussing FASB's latest simplification initiatives, learn how to adopt and simplify complex accounting over debt and equity. But before we get started today, I'd like to give a brief background of Wolf & Company. We were established in 1911 and have 2 centuries of experience providing our clients with assurance, tax, business consulting, and risk management services, including IT assurance, internal audit, and regulatory compliance. We have over 300 professionals working for the firm and have offices in Boston and Springfield, Massachusetts, Albany, New York, and Livingston, New Jersey. It's now my pleasure to introduce today's presenters, Cecilia Farrat and Jared Kelly. Cecilia is a principal in the Insurance and Advisory Department, as well as Jared. He serves as a senior manager in the Assurance and Advisory Department. Thank you both for presenting today, and I'll now be handing it over to Cecilia to get us started.
Hello, everyone, and thank you for taking time to listen to our webinar on ASU 2020-06, which details a newly simplified framework for convertible instruments. I think today's webinar is mostly good news, as FASB has eliminated some of the more complex and often confusing accounting models and disclosures over convertible instruments. Our agenda today is to first provide you with a high-level executive summary of the changes, and then to go through them in a bit more depth, starting with the changes to the accounting model, and then we'll discuss some other changes within this ASU, which include changes to diluted EPS, the derivative scope exception, and some enhanced disclosures. We'll then wrap up with a discussion on transition timelines and some suggestions on how to get started. So first, who is impacted? Essentially, all businesses are in scope, as this would impact any company raising capital through convertible debt or preferred stock. We see convertible debt and equity being issued by early stage and emerging growth companies across various industries, but most commonly within our technology clients, where we see convertible notes being issued to extend the cash runway in between rounds of equity financings. And what are the changes? The changes simplify the accounting for convertible instruments by removing cash conversion model and the beneficial conversion feature in the BCF model. Accounting for a BCF or a contingent BCF was often complex, and depending upon the size of the debt arrangement and the conversion discount would be very impactful to the financials, particularly the amount of non-cash interest expense recorded in the income statement. Jared's going to run through a few of these examples later on in this presentation to show the impact of removing these 2 models. In addition to removing these 2 models, we'll also go through how the standard modified the scope exception for derivative instruments, which will likely lead to more instruments qualifying for the exception, made notable changes to the rules for calculating diluted EPS, including that a company's assumed share settlement, and lastly, clarified disclosure requirements for convertible instruments and derivatives. Now, why are we doing this? As we know, FASB has been working on its simplification initiative and rolled out various ASUs to date. So FASB says its initiative is to reduce costs and complexity in financial reporting while improving the quality of information provided to investors. It also works to decrease diversity in practice and interpretation. It works to ensure that transactions of similar economic substance have similar accounting outcomes. And I do believe that they've been successful here in streamlining some of the accounting for convertible instruments. Now, when do we have to start? So larger public companies adopted this January, and private companies and emerging growth companies are required to adopt by 2024, with the option to adopt early this year. And we'll go through the methods of adoption a little bit later on in the presentation as well. And now Jared's going to walk us through some of the detailed examples of the updated accounting model.
Thank you, Cecilia, and hello, everyone. So in the next section of the slides, I plan to cover the changes to the accounting model for convertible instruments. And this, we feel, is really the biggest change from this particular ASU. So on this slide, the FASB concluded that eliminating certain models would simplify the accounting for convertible instruments and improve the relevance of the information provided to users of the financial statements. The FASB, they had extensive deliberation on this subject, and they received feedback that the existing legacy accounting framework was too complex and really too complex to interpret and apply, and that the end users did not value the information about non-cash interest expense, which was getting accounted for and reported on in the financial statements. So how did 2020-06 change the accounting for convertible instruments? First, it's important to note that by convertible instruments, we mean convertible debt and convertible preferred stock. We are only really going to focus on convertible debt changes in this session, but please be aware that the changes to the model are also to be applied to convertible preferred stock as well. We just simply don't see those type of transactions around convertible preferred stock often enough in the companies we work with, and there's enough to talk about with the convertible debt model changes. Now, this ASU eliminates the cash conversion and the beneficial conversion feature models, and it retained the other models illustrated on this slide. The ability to elect the fair value option for instruments eligible under ASC 825 was also retained. And as a result of these changes, we do expect that more convertible instruments will be reported as a single unit of accounting on the balance sheet. We'll go into the effects of this in more detail in the following slides, but the elimination of these two models will result in fewer instruments for which proceeds need to be allocated between a liability and equity, therefore resulting in fewer liabilities recorded with a discount. Now, the end effect of that would be less non-cash interest expense and an increase in net income being reported. So moving on, let's talk briefly about the models that were removed. So you're able to connect and familiarize to transactions you've seen and accounted for in the past. The cash conversion model would likely have been applied in instances which the issuer of debt has the option or a requirement to settle the debt in cash or shares. In these cases, a company would calculate the fair value of the debt and record the debt liability at that fair value. Any difference between the fair value of the debt and the proceeds received would have been recorded to equity. That difference or delta would have created a debt discount on the debt, which would require accretion as non-cash interest expense through maturity of the debt. Now, the beneficial conversion feature model, also referred to as BCF, would likely have been applied when a company concluded a conversion feature was not detachable as a separate accounting instrument, yet the conversion feature was in the money at the origination of the debt. Now, BCF accounting led to similar accounting as the cash conversion model, but slightly different. Here, a company would calculate the intrinsic value of the conversion feature at the origination date, and that amount would be recognized to equity. Again, this allocation between a liability and equity created a debt discount that was accreted as non-cash interest expense over the term of the debt. Both of those models hopefully sound familiar, but they are both gone and removed permanently going forward. So let's just forget about those models and turn the page to a simpler framework to apply. And it's certainly, as Cecilia mentioned, it's a welcome change that we do believe eliminates a lot of complexity. Now, this slide illustrates a flow chart to use with the new convertible debt accounting model. Now, first, you would review eligibility to account for the debt under the fair value option under ASC 825. If eligible, and you opt into that accounting model, this is where you'd stop in the flow chart. You'd really just follow the fair value treatment from that point on by adjusting the instrument to fair value at the end of each reporting period through earnings. If you don't qualify for the fair value option, or you just pass on that option, you would continue the steps. Now, we don't often see the fair value option applied, just given the volatility that it can have on a company's P&L from year to year, as you'd be running any changes in the fair value through the P&L. These fair value changes really have no meaningful connection to a company's performance and may, in some instances, really have unintended consequences, misleading users of the financials with that volatility going through the P&L. So next up in this flow chart, a company would be required to evaluate if a conversion feature requires bifurcation as a derivative, or if the debt was issued with a substantial premium. We do have some slides that cover this in a little more detail. However, just given the guidance on those particular items hasn't changed much, we aren't planning to do much of a deep dive in those areas today. Now, if neither of those two items apply, then a company would apply the traditional accounting model, which we will explain in some of the following examples. Now, I personally find that, learning a new accounting model, like most other things in life, is best learned when applying it to real life circumstances. So we've, worked up an example to illustrate the effect of this accounting change. On the right is an example of a common type of convertible debt financing that we see, and I'll just really quickly scan it and read it out. So on October 1st, ABC company closes on a convertible note fundraising in the amount of $2 million. The notes bear interest at 6% and mature on December 31st, 2022. Upon the closing of a qualified financing, which we have as $5 million from new investors, the principal and accrued interest will automatically convert into the same class and series of stock in that qualified financing at a conversion price equal to 80% of the price paid by the new investors. And if not converted, upon reaching maturity, the issuer and the holder will have the right or the option to convert into common stock at the then determined fair value. So, what is the before and after result of the cash conversion model being eliminated? So had the cash conversion model been applied prior to its elimination, here's probably what would have happened. And just hypothetically, say ABC company calculated the fair value of the debt at 1.9 million. That's the amount that would get recorded for the debt liability on the balance sheet, the 1.9 million. In the delta, the residual amount of $100,000 would be allocated to equity. This creates a debt discount of $100,000, which would be amortized to interest expense, non-cash interest expense over the term of the notes. Now, after elimination, assuming the traditional convertible model is applied, the debt liability would be recognized at $2 million. No debt discount, no non-cash interest expense is created. Certainly a much simpler approach. Now let's work through a similar before and after exercise with the BCF model. So the example on the right is very similar to the previous slide, just slightly tweaked for a scenario where a company would have likely applied a BCF accounting. Now, before, in having applied a BCF model, a company would have calculated the intrinsic value of the BCF as we've illustrated here below. So the fair value of the common stock being $10 a share, and debt would be converting at 20% discount to that. That would be $8 a share would be the effective conversion price. That implies a discount of $2 per share, which is multiplied by the number of shares issuable in the conversion, and that gets you to a BCF value of $500,000. Now that $500,000 would be recorded as a credit to equity, probably additional paid in capital, in a debit against the $2 million of principal on the debt as a discount. That discount gets amortized as non-cash interest expense over the remaining 15-month term of the notes. Now, after elimination of the BCF model, a company very likely would apply the traditional debt accounting model here. And with that, similar to the previous slide with cash conversion, the debt would be recorded at the $2 million of proceeds, no equity impact, no debt discount, and no non-cash interest expense as a result. So the next couple slides 12 and 13 here, kind of go through a little bit more information on the fair value option, the derivative bifurcation, and substantial premium evaluations that you would need to go through. Feel free to reference this information, but just like I mentioned before, given there were no substantial changes to these accounting models, I'll continue onto the more important slide, which is on the traditional model. So, now, again, just to clarify, the traditional convertible model would apply when, debt was not issued with a substantial premium or with an embedded conversion feature required to be bifurcated under the derivative rules. Also, if convertible debt was issued in conjunction with other rights or privileges, in addition to the convertible debt itself, then a portion of those initial proceeds would need to be allocated to those rights and privileges in accordance with the other applicable GAAP. So what comes to mind immediately would be some sort of warrant that you have to account for and allocate proceeds to. So under this traditional model, only the debt liability is recognized and no portion of the proceeds are allocated to any equity component. Interest expense would still be calculated using the effective interest method, but without an initial allocation of proceeds to an equity instrument or any other instrument, the debt will likely have no discount, meaning that applying the new framework would result in less reported interest expense in the financials. Now, if and when a convertible debt instrument that is accounted for under the traditional model is converted into shares, the carrying amount of the debt is simply reduced to zero. Any unamortized discount or premium created by other GAAP rules, like a warrant or maybe cash issuance costs that were deferred, would not need to be fully amortized to zero first. Just the carrying amount at the point in time of conversion of the notes would be recognized directly into the capital accounts of the company. Now, this illustration at the bottom of the slide here is intended to capture the financial statement impact, at all times while the convertible notes were outstanding and upon conversion. So the debt would be recorded at the initial proceeds of $2 million at the end of the first fiscal year. The only entries to make would be accruing the stated interest on the notes. And then when converted in the next fiscal year, you'd bring the principal and accrued interest to zero with the offset being to equity between par and APIC respectively. And then on the next slide, lastly, we wanted to finish this accounting framework discussion by comparing the effects of this accounting change with a scenario that we think will most commonly be impacted. So we've talked about that BCF model, and it's historically a widely applied model with convertible notes. So we're comparing the effects of the financial statement impact over the BCF model compared to the traditional model using the scenario that we had on the previous slides. So under the BCF model, you can again see the $500,000 of proceeds recorded to APIC upon issuance of debt, representing that the beneficial conversion feature. That created a debt discount, which amortizes down through year end, and you can see the cash interest expense and also the non-cash interest expense relating to the debt discount through 12/31/21. Upon conversion, the remaining debt discount was brought to zero through amortization through non-cash interest expense, and then the principal and accrued interest is reduced to zero and offset to equity. Under the traditional model on the right, things get a lot simpler. So there's no debt discount. You just have the stated interest expense, no non-cash interest, and the debt and the principal on the debt and accrued interest converts to equity upon conversion. It's as simple as that. So now I'll send it over to Cecilia to review some of the other changes brought on by ASU 2020-06.
Thank you, Jared. So the next change coming out on this ASU is around the calculation for diluted EPS and essentially how to treat convertible instruments within the calculation. Now, under the old guidance when calculating diluted EPS, a company's stated policy or its past practice may have been used to support assuming cash settlement in the EPS calculation, essentially providing a rebuttal to the presumption of share settlement. So this is no longer going to be the case. Once this ASU is adopted, when you're presenting diluted EPS, companies will be required to assume share settlement when an instrument can be settled in cash or shares. Companies will also need to use the as converted method, and the treasury stock method will no longer be permitted. So this is a fairly significant change in application, especially for companies with large numbers of convertible securities. It will result in a reduction of diluted EPS. And two other updates for the diluted EPS calculation are that the denominator should use the average market price and that's when the entity's share price may impact either the number of shares that are issued or the exercise price upon settlement. Now, FASB also clarified that companies should use the weighted average shares from each quarter when calculating the year-to-date weighted average share count for all potentially dilutive securities. So some rather significant changes for diluted EPS. And the next change came to the derivative scope exception. And that is within ASC 815 for derivative accounting. Now, as a reminder, freestanding instruments such as warrants or features embedded in other agreements like embedded conversion options may meet the definition of a derivative and require liability accounting, and that results in changes in the derivative's fair value running through the income statement. However, in making this derivative determination, ASC 815 includes a scope exception, and that's commonly known as the own stock scope exception. Now, qualifying for this scope exception allows an instrument to avoid being accounted for as a derivative liability, and therefore you're avoiding that mark-to-market fluctuation in the income statement. So the scope exception here is very impactful. And it is for contracts that are both indexed to an entity's own stock, that's the indexation criteria, and equity classified, that's the settlement criteria. And the scope exception has been often criticized as being too rules-based and for generating form over substance conclusions. So FASB has made changes to the second requirement, the settlement criteria, and has elected to move the review of the indexation criterion to a separate project, and that's still ongoing. That project over indexation is up on FASB's website. However, there is no exposure draft yet, so it's still in early stages. Now, the general concept behind the settlement criteria is that a contract will settle in a company's own equity shares meets the criteria, and a contract that requires or may require settlement in cash does not. And the old standard included 7 conditions that must be met. This ASU eliminates 3 of those conditions and clarifies one of the remaining conditions. So we've listed out here these changes. So the first one is the settlement is permitted in unregistered shares. So FASB has removed this criteria and explained that a requirement to deliver unregistered shares does not, by itself imply that an entity does not have the ability to deliver shares. A contract would have to explicitly state that an entity must settle in cash if registered shares are unavailable. Now, the next one was to remove the no counterparty rights rank higher than shareholder rights. And in removing this, FASB noted that this condition was really unrelated to the settlement of the contract. And the third condition that was removed was no collateral required. And in removing this condition, FASB discussed that the nature of the collateral is that it may be returned. So it may not be considered a cash settlement of the agreement. And then lastly, the condition of cash payment upon failure to timely file was clarified. And FASB explained that if an entity fails to make timely filings with the SEC, any related penalties would not preclude meeting the settlement criterion because they would not result in the settlement of the contract. So as you can imagine, these changes are expected to result in less instruments being reported as derivatives and more meeting the scope exception. And then we wanted to touch on disclosures. So the FASB noted in this review that disclosure requirements for convertible instruments and contracts in companies' own equity are generally sufficient, and therefore they didn't need substantial revision. They had some additional disclosures and clarified some of the disclosure requirements, and we have listed those out here, areas where incremental disclosures are going to be needed. So as you apply the new standard, you'll want to revisit disclosures, and in particular these bulleted items. Generally, the idea is that disclosure should provide financial statement users with information about the terms and features of the instrument, an understanding of how the instruments have been reported in the financial statements, specifically in the balance sheet income statement, and information about any events, conditions, or circumstances that would affect the timing or amount of future cash flows. So now Jared is going to discuss transition timelines.
All right. So, we understand that fundraising through convertible instruments can be a frequent transaction for many companies. So you might be wondering, how and when do I adopt, and which historical financings do I revisit? So this ASU requires adoption using one of the following 2 methods. The first is on a modified retrospective basis, which we expect to be commonly chosen. Here, a company would apply the standard to financial instruments outstanding as of the beginning of the fiscal year of adoption. And any cumulative effect of adoption is recognized on day 1 in that year of initial application. Any cumulative effect of the changes would be recorded as an adjustment to the opening balance of retained earnings. And then lastly, on this under the modified retrospective basis, EPS amounts would not be restated in the prior periods presented. The other option is the full retrospective basis, where a company would revise the accounting as needed to any convertible instruments outstanding as of the beginning of the first comparative reporting period presented. So assuming you have 2 years in your financial statements, you would go back to the immediate prior year and revisit any convertible instruments outstanding as of the beginning of the prior year. And note that under this method, EPS for all prior periods presented, whether it's 2 or 3, should be restated. Also important to note is that on the date of the ASU's adoption, the company is permitted to make a one-time irrevocable election to apply the fair value option for any liability classified convertible instrument. Probably not something a lot of companies are going to do, just given the reasons previously discussed, but this is an option. And now, when do you adopt this accounting standard? Public companies, except for smaller reporting companies, would need to adopt in 2021 if they are 12/31 fiscal year end companies. All other companies, non-public and smaller reporting companies who are public, are required to adopt in 2024. And you can early adopt, and we expect that most companies will, but you cannot apply these rules before 2021 for 12/31 fiscal year end companies. Now, there are some required disclosures, in the initial year of adoption of this ASU, and these disclosures are pretty standard for any time you have new accounting rules where there is a transition effect to be recorded. So, these disclosures explain to the users of the financial statements how the company applied the new standard, and how the transition was affected, and what the really monetary effects of the change were. We certainly can discuss and walk these through with you when it comes to preparing your financial statements in that year of adoption of the ASU. So now I'll send it back to Cecilia to discuss a little bit about how you might get started with this transition.
Sure, and you really, as of this recording, we're not yet in the fourth quarter of 2021, so there's still plenty of time for private companies to adopt this year. So if you've closed to financing this year or maybe contemplating closing of financing in Q4, I think it's absolutely worth considering early adoption, as the accounting will be simpler and it should make life easier for you. And that way, you're only really accounting for the transaction once and not having to redo the accounting and presentation, down the road if you postpone adoption until 2022 or beyond. And if you've had a financing in the prior year in 2020 on the books, I think it's a good time to discuss with your CPA the impact of adopting in 2021 and how this may impact your current year comparative financial statements. So, if you're an existing client, we encourage you to reach out to your engagement team, ask questions, talk about what adoption looks like this year. And if you're not, currently with Wolf & Company, we do offer advisory services where we can help you apply this accounting standard either on an ad hoc basis or as your outsourced accounting provider. So either way, happy to discuss this accounting standard or any others with you. And thank you again for your attendance on today's webinar. And today's presentation can be downloaded from our website at the link below. Thank you.
Thank you, Cecilia and Jared. I want to thank everyone as well for joining us today for this informative webinar. If you do have any additional questions after the conclusion, please feel free to reach out to both Cecilia and Jared. Here you'll find Cecilia's information as well as Jared's on the slide deck, where you're able to download it on the previous slide. Thank you again for attending, and we hope to hear from you soon. Have a great day.